Hello, welcome back to my YouTube channel. This is Aishwarya. We are seeing Accountancy of Class 11 under CBSE syllabus. This is Chapter 2, Part 2. In this video, we'll be covering the following topics. Now let's start with System of Accounting. So long we've been talking about how to enter the transactions, entering in the books of accounts, reporting, presenting and all that. Now, how we actually do it. There were two methods of doing it. It's double entry system and there's something called single entry system as well. So initially there was single entry system, just like how you just make a note of the transaction. Like if you're paying someone, you just mention you paid someone the date, and it's roughly a method like you maintain a book and you make a note of all the transactions. That's all. Like how you do for your um, pocket money calculation. Okay, so that single entry system had a lot of disadvantage, and that's how this double entry system came into effect. Okay, so single entry system, it records only one side of the transactions. It's not a complete system. Only personal accounts and cash book are kept. Okay, there will be only personal accounts and cash book. Whatever cash comes in and goes out, it will be recorded. And it's not a complete system. Only very small business use it. Like you can see some veggie vendors, flour vendors, they'll not maintain double entry system of accounting and all that. They'll just make a note of whatever they have spent in the market early in the morning for buying them, whatever sales they have made, whatever is saved, if it's a profit or loss, they'll calculate, and whatever money they've got, next day morning they'll go again and invest. For such small business, this single entry system is fine, because they're not liable to present it to other stakeholders. Okay, this is simple and it is not reliable because it is done in one's own way, so you can't rely on this. So on the contrary, if you see double entry system, it records both sides of every transaction. Okay, so every transaction has a debit and a corresponding credit. It will reflect minimum in two accounts. Okay, so it is based on a dual aspect principle. That's why it's called double entry system. Okay, one account is debited, then the other account is credited. So it's complete, accurate and reliable system. Okay, you can, if someone says that I have prepared based on the double entry system and followed all the accounting standards and policies, and I can rely on such person's accounting information, so it is suitable for all the organization. Yes. And fraud detection is also possible via trial balance, because after preparing all the ledger accounts, so it is brought to the trial balance, the totals are compared, and if there is any difference, if the trial balance doesn't tally, you have to get back and check if there is any mistake. Okay. Then double entry system is a golden rule. So every debit must have a corresponding credit. Yeah, we've been seeing this. Once we start solving, you will understand this more clearly. So it's a complete system. Okay, it looks into every aspects of transaction. They'll check the transaction, what is it, what is happening in this transaction, and accordingly you will record. There is an accuracy check. I told you trial balance will help that. And there is a fraud prevention, and it can be used for everyone. Then if you see while recording, okay, now I know how to record. Now when should I record a transaction? That question pops up. Should I record when I pay cash or when I get cash, or should I record when the revenue is earned or the expenses is incurred? Okay, there is something called cash basis, there is something called accrual basis. Okay, now when I say cash basis, whenever the cash is moved out, you record. When I pay, I record. No matter when I have made the purchase or when I have made the sales, when I pay or receive money, I record. So in this case, what will happen? This ignores credit transaction, and in case of credit transaction means I would have bought now, but I'll be paying in a later date. But it will come into my books of accounts only when I'm paying, right? So when I've made the purchase, that information will be totally ignored. So that's why the credit transactions will be ignored. And it is not compatible with the matching principle. Why? Because I have made the purchase now. I am paying 2 months later, so that will reflect in my books only 2 months later. But I would have, meanwhile, whatever I have purchased, I would have processed and made the sales also in the same month. Okay, so that matching principle of matching the expenses and revenues of that particular month will not find place when you are recording in cash basis. So you can't come to a conclusion of a proper profit calculation also. So cash basis is not a proper method of recording accounting. Okay, if cash basis doesn't work, then what is it? There's something called accrual basis. Record when revenue is earned. Now when a revenue is earned, I make a credit sales. Okay, immediately I am liable to receive that amount, right? So the same day I can go ahead and record that I have made a credit sales. We'll see with the examples also so that you can understand this better. Just try to understand the concept. And likewise, expenses are incurred. Now supposing I am liable to pay rent for my office premises this month. So I have to record it only this month. I might pay next month or the month later also. But this expenses is related to this month. So it has to be recorded and for this month only. Okay, you have to match revenue with related expenses. So as per accrual basis, you can match, because whenever you are incurring it, you are recording it, so you can easily match them. So this will record both cash and credit transactions. So even you do a cash sales, cash purchase, you can go ahead and record. But here cash is accounted, but credit it will ignore. Okay, this provides more accurate profit calculation, and it is widely accepted by most of the business. And important point is, it is compatible with the matching principle. So that particular months or that particular years, all the expenses and income can be matched according to the matching principle. Okay, we'll see an example. Now, example 1. Office rent for December 2014 is paid in January 2015. So if you are maintaining books as per cash basis, then when will you record? You will record in Jan 2015, which is not right. But in case of accrual, you will record in December 24 because the rent is pertaining to that particular month. And then there is credit sales. Next example, goods sold on credit in January 2015, payment received in April 2015. Okay, so there is a 3 months credit. So when you will actually record, you will record in the month of April in case you are maintaining books under cash basis. So recording of April. Can you compare these two? No. It's all kind of different. Just if you subtract these both, you will not get profit because it's all done under different month. So this method is inaccurate and misleading. Whereas in the accrual basis, now credit sales you will record in the same month. So that particular month, if the revenue is, or that particular year, okay, 24-25 accounting year, you can do the profit calculation easily, okay, till March 31st. So the result is accurate and reliable. So this is what we've got to do with cash and accrual. Next is accounting standards. Okay. Now we know what to record, we know how to record, we know when to record. But when it comes to how to record, it is just the double entry system we use. Okay, after I use double entry system, after I prepare a trial balance, there are furthermore steps that I need to follow. All that will be specified by the accounting standards. So accounting standards is nothing but the written set of rules given by ICAI, Institute of Chartered Accountants of India. They have given like how should you measure, how should you treat, how should you present, what all should be disclosed in the accounting reports of the company, so that the stakeholders can make maximum use of it. Okay. Now, this brings uniformity in accounting policies. Why do we need it? So if every other company is going to prepare their accounting reports based on accounting standards, definitely there will be uniformity, right? So this eliminates non-comparability of statements. So if all the reports are prepared in the same format, So by default, comparability will be easy. Hmm? Then enhance reliability of financial data. So if all the rules are followed, the one who is using it will definitely feel that the data is reliable. Okay. Then set standard valuation norms and disclosures. The valuation norms will be given in the standard, and the one who is preparing has to follow it accordingly. Okay. The benefits is, yes, it eliminates variation. Okay. It calls for useful disclosures. All important disclosures like your related party transaction, your segmental reports, the depreciation methods the company has used, all such disclosures has to be done. So it enables comparison. So when there is uniformity, obviously you can compare from company to company or your company report year on year, so it will be easy. A few limitations here is so it makes choosing between alternatives difficult. So if we see depreciation methods, there are various depreciation methods, so you don't know what to choose. Likewise, other calculations also, there might be different methods. So you have to think what to choose. That might be little challenging, and it is rigidly applied. It lacks flexibility. You have to just follow whatever is given. They are saying this is how assets should be valued, or this is how intangible assets is valued. You have to just go ahead and follow them. Okay, but it cannot override existing laws and statutes. So if the company law says that dividend should be issued, okay, only from reserves and profits of the company, the accounting standard cannot go ahead and mention that dividends can be paid to the stakeholders from shareholders from profit on sale of asset. So whatever this cannot go beyond the other laws. So that's what they mean. It cannot override the existing laws. It has to follow all the laws that has been already framed. Okay, next we'll see taxes. Now, what is a tax? We all know that we've been paying tax, various tax. Okay, so when you earn an income, you pay income tax, or you go buy out some product, you pay something called GST, right? So basically tax, this is not direct tax. So basically we'll see what is tax. The tax, there are two types, direct tax and indirect tax. So we pay money to the government, okay, so that the government can run the economy, the country efficiently. Okay, this has been happening from age old days, even during the king period. The people, basic citizens, they used to pay tax to the king, right, so that they can run their kingdom. Next we'll see what are taxes. So taxes are something that the government will collect from the people, the citizens, and then use them for all the welfare projects that will help the people. Okay, this was happening from age old days, even during kingdom times, where kings used to collect tax from its people. Okay, so now if we see taxes, they are of two types: direct taxes and indirect taxes. So under direct tax comes the income tax, and there's one more called wealth tax. So what are direct tax? Direct tax is a case where the government says a person that you earned an income, okay, a portion of this income you have to pay me as tax. The incidence and the levy is on the same person. Okay, so it levies a tax on me if I'm earning income, and I'm supposed to pay it. So that's the case of the income tax. So every year I'll be paying a part of my income as income tax to the government. Whereas the indirect tax, here the incidence and the levy is on two different people. Okay. So what will happen? When goods and services are produced, okay, the manufacturer, the wholesaler, the retailer, all these people, on them the tax will be levied by the government. Okay, so the people, they will pay the tax to the government, and whatever they have paid, they will add that amount to the cost of the product or service, and at the end the customer who uses such product or service will be paying the tax out of his pocket, not to the government but towards the price of the product or service that is being used. Okay, that is what it is, indirect taxes. So basically we are only as customers paying all these taxes. Okay, though the levy is on some other people, the government will not come and ask me, come pay GST in the GST department. No, that person who is manufacturing, producing, selling, the retailer, they will pay off to the department, we will pay to them. Okay, whereas in income tax, I myself, I go to the department's portal website, I pay my tax. Okay, that is the major difference. So earlier this indirect tax was collected by center and state in various forms. So there's something called central government and state government. I hope you all are aware of it. Okay, so the central government, so they used to collect something called service tax. Now there was separate tax for goods and services. Okay, excise duty, which used to come on manufacture, and there is CST, central sales tax, when there is transactions between two different states. All such taxes used to go to the central government. Okay, whereas value added tax, entry tax, octroi, luxury duty, all this will be collected by the state government, so that they had a fair share of tax from the government. So in the year 2017, there's something called GST that came into the picture, and all these taxes were replaced by GST, so that there will be one nation, one tax. Okay, GST is nothing but goods and service tax. One country, one tax. So what is this GST? How did it eliminate so many taxes? Okay, it is a destination based tax on consumption and goods of services. Okay, supposing I am in some state, say for example I am in Assam. Okay, so there I go and buy something, so I pay GST to that place. So whenever I buy the final product, there I'll be paying GST. Okay, that will go to that particular government. So it is a destination based tax. So wherever the person is using, so if I'm going to a restaurant, I'm paying the bill, my bill will have GST to it. So the end consumer will pay the tax. So that's why it's called the destination based tax. Okay, and here only value addition is taxed. Okay, when the goods moves from manufacturer to wholesaler to retailer, so only whatever the value they have added will be taxed and not the entire amount. So the burden on the final consumer will be much lesser. So if you see the basic features, it is a destination based tax. Wherever you are consuming it, there the tax you have to pay. So if you are buying it in Tamil Nadu, you have to pay there. If you are buying in Madhya Pradesh, you have to pay there. Excuse me. So there you have to pay. Then it is the taxes levy at all stages from the manufacture to the final consumption. This I'll explain with an example. Likewise, input tax credit can also be set off against the next stage. This also we'll see with an example so that you can understand better. And there is dual administration. Both the center and the state has a simultaneous levy of tax. So if you can take a restaurant bill or a grocery bill, just go see the end part. Okay, after all the final amount, just before the final amount, there will be something called CGST and IGST. If you have never observed CGST and SGST, you can go check. The percentage will be mentioned and the amount will be mentioned. Now we'll also see what that in the forthcoming topics. Okay, yeah, I'll just tell you what is CGST, SGST and IGST. CGST is nothing but Central Goods and Service Tax. So who will take this? This revenue will directly go to the central government. So central government, earlier it was collecting so many tax, right? Now it will take the amount from the CGST. So what will happen if some Ramesh from Punjab sells goods worth 10,000 at 18% GST to Seema from Punjab? Okay, so here 18% out of 10,000 is 1,800, of which 900, which is the 9%, the half of it will go to the CGST, which is the central government. Now SGST is nothing but state goods and services. The balance 900 of the same transaction will go to the Punjab government, which is the state government. And state government, earlier it was collecting all these tax, and now they are eligible to receive these two. So the total GST amount is 1800 will be paid by SEMA. Okay. So this part I hope it is clear. You can take a bill, any bill you can check. Okay, a GST bill you can check. You will find CGST, SGST with the same amount. Then comes the IGST, Integrated Goods and Service Tax. So this is a revenue. It goes to the central government and later it will be shared with the states. Okay. When it is used, it is charged for interstate transfer. Okay. So Ramesh from MP is selling to Anand of Rajasthan. So the goods are moving from Madhya Pradesh to Rajasthan. It is an interstate transaction. So here 18% on 1 lakh, which is 18,000 GST, will directly go to the central government. Okay, so this is components of GST. We will see what are the advantages of GST. Before that, I will take you to an example of how taxes were calculated before GST and after GST. Now this is the example. Manufacturer sells to wholesaler, wholesaler sells to retailer. Value added initially it is 1000. Tax rate they have kept it as 10%. Okay. Pre-GST there was excise duty and VAT. Excise duty is paid on manufacture of the goods. So manufacturer used to pay, and later the value additions there used to be something called VAT, value added tax. Okay. Now post GST it is GST with full input tax credit. Now how is it reflecting? We'll check. Okay. 1 second. Just pay attention. Now, so first stage manufacturer, there is a good costing 1000. Okay, so he has paid excise duty on it 100 rupees, and the selling price he has added 1100. So he has sold it to a wholesaler. He has bought it for 1100. He has added 200 rupees value to it. Okay, so his final price will be 1300, which is 1300. On that he'll pay VAT of 10%. Okay, so the final selling price will be 1430, which is 1430. At this price he will sell to the retailer. Retailer will add his own margin. Okay, and the total price is this. On that he'll be again paying VAT, which is of 10%. And then his final price selling to the customer will be 1793. So in this case you can see already there is tax on this. Again there is a tax calculation. These two tax are again added here, but again on that there is a 10% of calculation, tax on tax, tax on tax. That is called the cascading effort. Cascading effect. So paying tax on tax. So GST has ideally removed this. Okay. Now, same example if we see manufacturer, his cost is 1000 rupees, 100 rupees, 10% of 1000 is 100. So he is paying 100 rupees to the department. Since he has previously not paid any tax, there is no ITC. Input tax credit you can claim when you have already paid a GST, you can deduct from your current GST liability. Okay. So he is paying 100 rupees to the department, and he is adding that whatever he has paid to the selling price, okay, as expenses. Now wholesaler, actual price though he would have also bought for 1100, but he'll keep the tax amount aside. He'll consider 1000 and he'll add up his value 1200, and the total price is 1200. Okay. On that he will calculate what is his tax liability. His tax liability is 10% of 1200, which is 120, of which that sets amount aside 100 rupees which he has paid to the manufacturer, right? He will subtract because he's already paid GST to the previous from the person from whom he is bought, right? So only the difference net 20 rupees he will be paying to the department. Okay. So So this is called input tax credit. Whatever tax I have already paid, I take a credit of it. Now his final price will be 1200 plus the tax of this, which is 1320. Okay, at this price he will be selling to the retailer. Again, retailer knows, since they'll all have the GST bill, they'll know the amount, so they'll set aside 120 rupees of GST, he'll set aside, and 1200 to that he will add his value. Okay, and then total amount will come to 1400, of which the GST liability is 140. Okay, but he has already paid 120 here, so the difference, only 20 rupees he'll be paying to the department, and 1400 plus 140, 1540, the final amount will be paid to the it's a price to sorry, this is the price at which he'll be selling it to the end customer. Okay, so if we see, we can see here in the first stage, government has received initially 100 rupees, and then the wholesaler pays 130, retailer pays 163. Total tax is sorry, yeah. Yeah. So the total tax paid to the government was 393. Okay, whereas after GST, what has happened? Manufacturer here paid 100 rupees, wholesaler has paid 20, retailer has paid 20. Total tax to the government is 140. Okay, and the final price to the customer here, it is offered for 1793, and here it is 1540. There is a vast difference, right? We'll see the comparison. So the final price pre-GST was much more, 1793. Post-GST it is less. So consumer is at a benefit. Tax, government, though the government tax has reduced, the government eventually it made profit. I'll tell you how. Okay, so tax on tax in pre-GST it was there, but they have removed in post-GST. Okay, there's a savings of 253 rupees. It has made the goods and services cheaper, and cascading effect, nothing but tax on tax was there earlier, now it is not there. That's what GST is all about. I hope it's clear. Next we'll see the characters of GST. It's a common law and procedure throughout India. Throughout India you've got to follow it. It is a destination based tax. So at the point of consumption the tax is paid. And then it's comprehensive for both goods and services. Earlier there was VAT for goods and service tax for the services. Okay, so few bills used to have VAT and as well as service tax, but now it is only comprehensive tax, only one tax. So minimum two it's given minimum 2 tax rates only in your book, but actually it is 3. And the government will also keep changing. We don't know. There is no cess, retail tax or additional levy. There is no other. Usually on tax they'll add few other tax called cess, but here no such addition is there. No multiple taxation. There's only single tax. Okay, and advantages, it abolished multiple types of tax. So in the flowchart I think we saw so many types of tax. All such tax have been replaced by GST. So it has widened the tax base. So it has brought so many small businesses which were earlier not taxed into the GST, and so that all the businesses are bought under GST and the tax is collected and paid to the government. So that's how the tax base has been widened. In a way the government revenue is also increased. It reduced compliance and administrative costs. So earlier They were, if you're running a business, you have to get service tax registration, VAT registration, you have to go pay under that, under this, but now it is only one. So from a business point of view also it is easy, it has reduced compliance, and from the government also, it is only one tax department that will be handling. For them the administrative cost has also come down. So there is no cascading effect, no tax on tax. Okay? It is boosting manufacturing and distribution efficiency, because earlier when there used to be transaction between one state to another, there used to be so much taxes, and now with single GST it has made it more simplified. Then promotes economic growth, international competitiveness, increase exports by making goods competitive globally. So you've seen the price of the goods have come down because of GST, okay, avoiding all the taxes on tax. So whereby it not only promotes economic growth for our country, and even in the international market our price has been much competitive, much lesser, so thereby adding a advantage. Okay, we'll do a quick revision. So first we saw what is double entry, single entry system. Double entry is a complete reliable method. Single entry is a incomplete method only for small business. So cash basis, we record only the cash transactions. Accrual basis, we record whenever the income or income is earned and expenses is incurred. Then we saw what is accounting standard. It is a uniform comparable, it is a set of rules given by ICAI for recording the transactions. Then GST, we saw what is CGST, SGST, and how income is split between center and state. Okay. Then IGST, income is collected by the central government and later shared with the state government. So with this we have come an end of this video. So if you have any doubts, do let me know in the comment section. The same video is also available with Tamil explanation. If you like the video, subscribe and share with your friends. See you in the next video. Bye bye.